The final hour of the trading day often reveals more about the market's true structure than the rest of the session combined. By this point, intraday flows have typically settled, dealer hedging is most active, and price begins to gravitate toward balance. The option chain shows this transition clearly. As call and put sellers converge, the day's range tightens, and price becomes pinned between defined zones of exposure. In this video, we'll look at how these late session structures form and how traders can use them to anticipate where price is most likely to close. A closing range forms when price settles between opposing zones of net GEX, where call and put positioning balance to contain movement into the close. As expiration approaches, dealers hedge aggressively to stay delta neutral, which under certain circumstances keeps price contained. The result is a narrow, controlled range into the close. Recognizing this evolution allows traders to shift their focus from chasing direction to anticipating the zone where balance will take hold. Throughout the session, call sellers define the upper boundary, while put sellers reinforce support below. As the day progresses, these zones often move closer together, tightening into a clear range where both sides have significant exposure. In the final hour, price action slows as hedging activity tethers it to this middle ground. To identify these upper and lower bounds within the last hour, we use the Net GEX column of the option chains. We primarily focus on sold call and put levels as the primary source of information, though there are times where long call or long put levels can help provide additional guidance. When puts are sold, they generate positive GEX, which reflects bullish positioning from dealers. On the put side of the option chain, this appears as positive GEX values. To identify the lower boundary of the range, look for the strikes with the highest positive GEX readings. These represent areas where put sellers are most active and price is likely to find support. When calls are sold, they generate negative GEX, which reflects bearish positioning. On the call side of the option chain, this appears as negative GEX values. To define the upper boundary of the range, identify the strikes with the largest negative GEX readings. These zones represent where call sellers are concentrated and where price is most likely to encounter resistance. Together, the high positive GEX on the put side and the high negative GEX on the call side create the range that will typically contain price action throughout the session. Often we'll see long put positions aligning with sold call strikes, and this overlap provides additional confirmation that a specific level is likely to hold into the close. Conversely, when long call positions align with sold put strikes, it strengthens the downside support as both flows work together to stabilize price and limit further declines. These alignments between long option positions and opposing sold strikes help validate which ranges are most likely to contain price as the session concludes. Before reviewing examples, a few clarifications are important. On high volatility days with large price swings, it's often best to avoid trying to identify the closing range altogether. In zero DTE negative GEX environments, or during strong trending sessions with high GTS, there's an increased likelihood that previously identified levels will fail as flow shifts become more aggressive. If the option chain doesn't show a clear, balanced range into the final hour, caution is advised. At times, one side of the chain may be well defined while the other remains unclear. The goal is to trade only when the structure is visible and at least one level is clearly established. Now let's work through a series of examples. As we review each one, we'll focus on two key criteria. Clear boundaries, clusters of high positive GEX on the put side defining support, and high negative GEX on the call side defining resistance. Alignment of flows, where long puts align with sold calls or long calls align with sold puts, reinforcing those containment zones and increasing the likelihood that price will hold within that range into the close. 1 hour before the close, call sellers established a firm position at 67.60, forming a clear upside boundary. While there were smaller strikes near price on the call side, 67.60 stood out as the largest sold GEX node and acted as the key level to watch. On the put side, 67.35 was the main area of support, expected to contain the lower range. Into the close, both boundaries held, and price remained contained between the sold call and sold put zones. In this example, the largest sold call GEX node was at 67.50, defining the upper boundary, while the strongest sold put node was at 67.20, marking the lower boundary. The 67.50 call strike was also reinforced by heavy buying of the 67.50 put, further strengthening that level as resistance. As the session ended, price closed near 67.35, right between the two containment zones. Here, 66.85 appeared as the potential upside boundary, while 66.60 defined the likely downside range for the remaining hours. Although price briefly tested the 66.60 level, the sold call zone held firm and the market closed at 66.71, confirming that the established structure contained price effectively into the close. In this case, the structure was less clear. The 67.25 call strike showed the strongest negative GEX reading, identifying it as a potential resistance level. However, on the put side, there was no clear sold level providing support. With only one side of the structure defined, it was best to avoid trading the put side levels. By the end of the session, price closed at 66.06, below the identified call resistance, underscoring the risk of attempting to trade the side of the chain where levels are not clear. In this final example, call sellers were dominant at 67.85, creating the largest negative GEX node and defining the upper boundary, while put sellers at 66.50 marked the lower range. However, GEX Trend Strength showed a strong upward trend, suggesting that upside levels were vulnerable to failure. As expected, price pushed above the 67.85 level into the close. This illustrates how, under normal conditions, sold levels contain price, but in high GTS, strongly trending environments, those same levels are more likely to break. Understanding how ranges form gives traders a practical edge in the final hour. It allows them to avoid unnecessary directional trades when the market is positioned for compression. Short premium strategies such as iron flies or iron condors perform best in this environment, while directional traders can use the identified range boundaries to refine entries and exits while managing expectations. Recognizing that price is being drawn into balance helps prevent chasing false breakouts late in the day. In this video, we explored how the option chain evolves in the final hour to reveal where price is most likely to be contained into the close. By identifying where call and put sellers align, traders can define the range that contains price and anticipate the session's closing levels. We also covered how alignments between long and sold positions reinforce these zones, and how elevated GEX trend strength can signal when those levels may fail. To see these structures play out in real market examples, review our historical sessions in Discord and explore our other videos, where we continue breaking down the Phoenix dashboard and how to use it effectively in your zero DTE trading. This content is for informational and educational purposes only. The concepts discussed in this video are intended to demonstrate how SPX Gamma's proprietary indicators can be used to inform and enhance the decision-making process. Nothing presented here should be interpreted as financial, investment, or trading advice. Trading involves risk, and you should always conduct your own analysis or consult a qualified financial professional before making any trading decisions. Past performance is not indicative of future results.